Ever felt like you're playing financial whack-a-mole? One minute you're trying to save, the next the surprise bill pops up and you wish there was a clear path, maybe a shortcut to feeling really confident about your money. If that sounds familiar, that constant juggling act, then you are definitely in the right place today. Because today we're doing a deep dive into something absolutely vital for navigating modern life. Financial literacy, what it is, why it matters so much right now, and most importantly, the actionable steps you can take today to build that financial muscle, gain control, and, reduce that stress. It's actually pretty surprising, but Quicken highlighted this Mind Over Money survey, finding that a huge 77% of Americans feel anxious about their finances. And here's the kicker. Even with new efforts at financial education, American financial literacy is actually declining. So this isn't just about numbers, it's about feeling empowered, finding some calm in a complex world. Our mission today, cut through the noise, give you the core understanding and practical steps to become more financially responsible, starting right now.
It really is fascinating, isn't it, that anxiety is so widespread and it just highlights how important this conversation is. To really unpack this and give you those actionable insights, we've pulled together some fantastic sources. We're looking at guides from Harvard College, practical advice from big names like Capital One and Quicken, plus Investopedia's ultimate guide to financial literacy for adults. So it's a really holistic view, academic thinking mixed with real-world banking smarts. It should give you a well-rounded and, like you said, actionable picture.
Exactly, because it's not about memorizing jargon, is it? It's about building a foundation for your own freedom, cutting down that anxiety. Think about your goals. Maybe buying a car, renting an apartment, maybe even owning a home someday. Or just, handling the money side of finding a job, like Harvard points out. Financial literacy is underneath all of it.
Precisely. And big picture. Financial literacy is like your shield against bad decisions that can really set you back. It's about becoming self-sufficient, achieving stability, and maybe even helping your family navigate tricky financial stuff. As Investopedia notes, it's about being ready for life's twists and turns, not just one purchase. Ultimately, it's about laying a strong foundation for your whole future, making sure you can adapt.
Okay, so we've established the why. It's crucial. We want control, we want confidence. But looking at this huge landscape of personal finance, it can feel a bit overwhelming. Where do we even start? What's step one on this journey?
That's the perfect question. And the answer, maybe surprisingly basic for some, is simple: bank accounts. It might seem obvious, but having a bank account is really the fundamental first move towards a stable financial future. It's kind of wild to think, but Investopedia mentions about 6% of U.S. households still don't have one. And that lack of a basic account, it creates these hidden barriers to stability in today's economy.
Wow, 6%, that really drives home the accessibility issue. So, okay, beyond just holding cash, what are the real benefits? What does having a bank account actually do for us today?
Well, it boils down to two key things: security and functionality. First, it's just way safer than keeping cash stuffed under a mattress, right? Your money's protected. Here in the U.S., bank deposits are generally insured by the FDIC, the Federal Deposit Insurance Corporation, or if it's a credit union, it's the NCUA, the National Credit Union Administration. What that means for you is, if the bank fails, your deposits are insured up to at least $250,000 per depositor, per institution, per ownership type. That's a huge safety net.
Okay, that insurance piece is massive peace of mind.
Absolutely. And beyond that safety net, think about how much we do financially these days that basically requires an account. Using a debit card, payment apps like Venmo or PayPal, getting paid via direct deposit, paying bills online, applying for loans. All of that hinges on having a bank account. Without one, you're kind of operating on the fringes, making daily life harder, probably more expensive, and definitely riskier. So the actionable step here is crystal clear. If you don't have one, open one. It's step one, foundational.
Non-negotiable, got it. But are all banks basically the same deal, or are there different types we should think about, especially if we're just starting out or maybe looking for a better fit?
That's a great point, because they're not all the same under the hood. Investopedia highlights two main players you'll run into: retail banks and credit unions. Retail banks are usually what people picture first. They're for-profit companies offering the whole range: checking, savings, loans, credit cards, insurance. They can be traditional brick-and-mortar places with branches or online only, though most big ones offer both now. They often have really advanced tech, lots of ATMs, lots of locations.
Okay, so that's the typical bank. What about credit unions then?
Credit unions are different. They're not-for-profit, and crucially, they're owned by their members. So you are an owner if you bank there. They offer similar stuff: checking, savings, loans, but often with lower fees and better interest rates, which is a big plus. People often say they have more personalized service, the trade-off.
Mm.
Usually fewer branches and ATMs compared to the big national banks.
Right, so a different philosophy almost. Member-owned versus shareholder-owned.
Exactly. And that leads into another choice, online versus brick and mortar. Online banks often give you better interest rates on savings because, well, they don't have the overhead of physical branches. The convenience is amazing. You can do everything from your phone. But some people still value being able to walk into a branch. It really depends on what you prefer.
That makes sense. It's about finding the right fit for your style. So once we've picked an institution type, what about the actual accounts? What are the main options we should be looking at?
Right. Think of it like building your financial toolkit. Investopedia breaks down three main types you'll likely use. First, the classic savings account. Basic interest-bearing account. The interest rate isn't usually huge, but it's safe, reliable, perfect for stashing cash for short-term goals, or, crucially, building that emergency fund we'll talk about. Just a quick note, sometimes there are limits on how many times you can pull money out each month, but generally they're pretty flexible for accessible savings.
Okay, savings account for, well, saving. What's next?
Next up is the checking account. This is your workhorse account for daily transactions. It's super liquid, meaning you can make lots of withdrawals easily. But the trade-off is you earn little to no interest. This is where your paycheck gets deposited, where you pay bills from using your debit card or online transfers, where you get cash from ATMs. Key thing to watch out for here, fees. Some are fee-free, others charge monthly fees or fees for overdrafts or using other banks' ATMs. Read the fine print.
Right, gotta watch those fees. Any other types?
Yes, the third main one is the high-yield savings account. The name says it all. It pays a much better interest rate than a standard savings account. Often, you'll find the best high-yield rates at online banks. The catch: sometimes they require bigger initial deposits or need you to keep a higher minimum balance, maybe higher fees if you drop below that minimum. But if you have some savings you want to grow a bit faster without taking on investment risk, this is definitely something to look into. That's an actionable step right there. Shop around for rates, especially online.
Fantastic overview. Really clears up the basic banking choices. So now your money's safe, it's accessible, but the next big step is knowing where it's actually going and making it work for you. Which brings us to budgeting. Budgeting. Quicken calls it the foundation of good money management. Harvard just calls it a plan for your money. But it feels like more than just a plan, doesn't it? It's like your financial GPS.
It absolutely is. And the real power behind it is why it works. It forces you to really understand your income and, maybe more importantly, where your money is actually going, your expenses. This visibility helps you avoid the #1 financial trap Harvard mentions: spending more than you earn. A good budget puts you in control. It helps cut down stress, limit that impulse spending, and make sure you actually have funds for the things you want to do. Capital One also stresses it's a key first step toward financial literacy and building healthy habits. It flips you from being reactive to being proactive with your money.
Okay, sold on the why. It's our GPS. How do we actually build one? Can you walk us through some practical, actionable steps someone could take, like today?
Definitely.
Yeah.
Harvard's guide gives a really clear roadmap. Step 1, build a starting budget. Don't aim for perfection here. Just make your best guess of what you spend monthly in different categories: rent, food, phone, fund money, etc. It's just a baseline.
Okay, so start with a guess. What's next?
Step 2, track your expenses. This is crucial. For a few months, track everything. Check your bank and credit card statements, keep track of cash spending, then compare your actual spending to your initial guess. This is often the eye-opener. You might be surprised where you were way off. Maybe eating out costs way more than you thought. This tracking gives you real self-awareness about your habits.
Right, the moment of truth. What happens after tracking?
Step 3, compare to income and adjust. Look at your total tracked expenses versus your income. Are you spending more than you make? If so, something's got to change. Which leads directly to step 4. Be honest. Needs versus wants. This is huge. Harvard uses a great example, that daily store-bought coffee. It's a want. Cutting back from daily to maybe weekly could save you, say, $80 a month. Now let's really make that concrete for you. That $80 a month is nearly $1,000 a year. Add in maybe some late-night snacks a few times a week, another $1,000 a year, weekend fun, maybe $1,500. Suddenly you're looking at over $3,500 a year just on those small wants. Over 4 years, that's over $14,000. Harvard points out that's potentially enough to buy a car. It shows the massive impact of tweaking those wants.
Wow, okay, that example really hits home. Small changes, big impact. What's the final step?
Step 5, review and adjust monthly. A budget isn't carved in stone, it's a living document. Your income changes, expenses shift, goals evolve, so you need to revisit it regularly, maybe monthly, and tweak it, make sure it still fits your life. That ongoing review makes it a truly useful tool.
That needs versus wants breakdown is powerful.
Okay.
So we have the steps, but are there different styles of budgeting or tools to make it easier? Maybe some suit different people better.
Oh, for sure. Budgeting isn't one size fits all. Capital One mentions a few popular methods. There's the 50-20-30 method, super simple template. 50% of your take-home pay goes to needs, rent, utilities, groceries, 30% to wants, dining out, hobbies, and 20% to savings and debt paydown. Investopedia likes it for hitting goals and saving for emergencies.
Okay, 50-30-20 sounds straightforward. What else?
Then there's the zero-based method. This one's for people who like total control. Every single dollar you earn gets assigned a job, an expense, a savings goal, debt payment, income minus outgo equals zero. Very intentional. And for a more hands-on approach, there's the envelope method. You literally put cash or allocate funds digitally into envelopes labeled for different spending categories, groceries, gas, entertainment. When the envelope's empty, you stop spending in that category for the month. Great for visual learners or if you tend to overspend in certain areas.
Interesting. Physical envelopes or digital ones, too.
Exactly. You can do either way now. And as for tools, yeah, lots of options. You can still go old school with pen and paper. Harvard mentions tracking sheets or worksheets. But honestly, budgeting apps are huge now. Many are free, they link to your accounts, automatically categorize spending. Quicken points out they save a ton of time and stress. Just read reviews, try a few, see what clicks for you. There's also personal budgeting software, like Quick and Simplify, that automates even more and gives you a really clear picture.
Lots of tools out there. Any final tips on making a budget stick?
Yeah, a really important one from Harvard. You got to follow it for more than just a month or two. If you find it really hard to stick to, it probably means your initial numbers weren't realistic. Don't give up, just adjust it. Maybe you need more for books, but less for clothes right now. The best budget is the one that actually works for you and changes as your needs change.
Great advice. It's a flexible tool, not a punishment. Okay, knowing where money goes is step one. But what about building your financial reputation? Managing debt? Let's talk credit. Credit. It's more than just plastic cards, right? Harvard calls it a major factor in today's economy. Basically, your reputation as a borrower. It's like your financial fingerprint, affecting huge life decisions.
Absolutely. Capital One highlights its impact on buying a house, leasing a car, getting a credit card. Harvard even notes it can affect getting certain jobs. It's incredibly pervasive.
So why does it matter so much? What's the real benefit of having good credit?
The bottom line is, good credit saves you money. A higher score means lenders see you as lower risk. That translates directly into lower interest rates on pretty much everything. Student loans, credit cards, car loans, mortgages, even insurance sometimes. We're talking potentially thousands of dollars saved over your lifetime just because you managed your credit well. So understanding it, actively managing it, that's a core part of financial health. It keeps more money in your pocket.
Okay, so it's our financial fingerprint and it saves us money. How do we actually see this fingerprint? What's a credit report and what's the immediate action step here?
Your credit report is the detailed backstory. It's got your personal info, job history, and a list of all your credit accounts open and closed and how you've managed them. 3 main companies compile these reports: Equifax, Experian, and TransUnion. And the most crucial, actionable step you can take: get your free report. You are legally entitled to 1 free copy from each of those 3 bureaus every single year. Go to the official site, annualcreditreport.com.
Once a year from each. Why is checking it so important?
2 big reasons. First, accuracy. Errors happen, and even small mistakes on your report can drag down your score unfairly. You need to catch those and get them fixed. Second, and this is really critical, fraud detection. Harvard points this out. If someone steals your identity and opens credit in your name, you might not know unless you check your report. Catching that early can save you a world of hurt. It's a simple, free check with huge protective power.
Okay, check the report at annualcreditreport.com. Got it. So that's the history. Then there's the credit score. What does that number actually tell lenders?
The score is like the snapshot summary. Harvard calls it a snapshot of your credit risk at that moment. The most common one, FICO, goes from 300 to 850. Most folks are between 600 and 800. Basically, the higher the score, the less likely lenders think you are to default on a loan. It's their quick way to gauge your creditworthiness, influencing the terms they offer you. Think of it like a financial GPA.
Financial GPA, I like that. So if we want to boost that GPA, what are the key factors? What actually goes into that score and what can we actively do about them?
This is where you really have control. Harvard breaks down the 5 factors and their weight. Number 1, the absolute heavyweight champion is payment history. This is 35% of your score. The single best thing you can do. Make consistent, on-time payments, always. The impact of being late is huge. Just one payment over 30 days late can stay on your report for 7 years and potentially drop your score by 90 points or more.
Wow, 90 points just from one slip-up. That's massive. What's next?
Second biggest is the amount of debt, making up 30% of your score. This is about how much you owe compared to your total available credit, your credit utilization ratio, the golden rule from Harvard and Capital One. Keep that ratio below 30%. So if you have 2 credit cards with $500 limits each, that's $1,000 total credit. You'd want to keep your combined balances ideally below $300. Lower is generally better.
Okay, keep balances low relative to limits. What else?
Third is length of credit history, at 15%. Lenders like to see you've managed credit responsibly over time. A simple, actionable step. Get a no annual fee credit card, use it for a small, regular purchase each month like Netflix, and pay it off in full every single time. That builds history easily. And like Capital One mentions, think twice before closing very old credit cards, as that can shorten your average history length.
Interesting point about closing old cards. What are the last 2 factors?
Fourth is new credit, accounting for 10%. Every time you apply for new credit, the lender does a hard pull on your report, which can ding your score by a few points temporarily. Doing this too often in a short period looks risky to lenders. That inquiry stays on your report for 2 years. The advice from Capital One. Only apply for credit you actually need. Be strategic. And fifth, also 10%, is credit mix. Lenders like to see you can handle different types of credit responsibly. Maybe a credit card, a car loan, a student loan. It shows versatility. Now, if you're just starting out, your mix might be limited, and lenders usually understand that. The key is managing whatever credit you do have really well.
That breakdown is super helpful. Payment history, amount owed, history length, new credit, credit mix. Very actionable. Now let's focus on credit cards specifically. How should we think about using them responsibly, especially compared to debit cards?
Great question, because they function very differently. Investopedia lays it out clearly. Debit cards pull money directly from your checking account. You can't spend more than you have. Crucially, they don't build your credit history. Credit cards, however, let you borrow money from the issuer up to your limit. Useful for big purchases, right?
Yeah.
But, and this is the huge but, if you don't pay the balance in full each month, you get charged interest, sometimes very high interest, and that debt can snowball. Investopedia mentioned Americans owed over $1 trillion in credit card debt in late 2024. That's a lot.
Yeah.
It really highlights the risk if you're not careful.
$1 trillion. Yeah, that's staggering. So given that risk, why are credit cards still seen as so important for building financial health?
Because when used responsibly, they are powerful tools. Paying your bill on time, every time, is essential for building that positive credit history and boosting your score. Good credit, as we said, saves you money on future loans. Plus, Investopedia notes they offer convenience and a safety net for unexpected costs when cash isn't immediately available. The key is discipline. They're a tool for growth if used wisely, a burden if not.
Discipline is key. You mentioned interest. Let's talk APR. What is it and why should we care?
APR stands for annual percentage rate. It's the interest rate you'll pay on any balance you carry over month to month. You absolutely need to know the APR before you sign up for a card. A high APR can cost you a ton of money if you carry debt. The median APR recently was near 25%. That's the cost of borrowing on that card. Knowing it is basic financial literacy.
Okay, pay attention to the APR. How do we choose the right card? And use it well.
Your credit score is the starting point. If you're new or have shaky credit, Investopedia says you'll likely start with a secured card, where you put down a deposit, or a subprime card to begin building a positive track record. With fair to good credit, your options explode. Travel rewards, cash back, balance transfer cards to move high-interest debt, low-no APR cards. Before applying, Harvard advises comparing everything: annual fees, the APR, rewards, credit limits. Find the best fit for your spending habits and goals once you have it. Pay on time. Pay the balance in full monthly if you possibly can. Try not to carry a balance. Make occasional, sensible purchases you can pay off quickly.
Makes sense. Any other tips on managing credit cards?
Yeah, remember you have rights under the Equal Credit Opportunity Act. Definitely, as Capital One advises, monitor your credit reports regularly for errors and keep an eye on your score. Tools like CreditWise from Capital One are free. They don't hurt your score by checking. And they even have simulators that show how certain actions might affect your score. Super useful for staying on top of things.
Excellent. So we've covered building that financial reputation. Now let's talk about building a cushion, the foundation for everything else. Saving. Saving money. Harvard calls it one of the most important things you can do to secure your financial well-being. It feels foundational, doesn't it? Not just a nice to have.
Absolutely. The amazing thing is, even small amounts saved regularly build a powerful foundation for success. Capital One agrees, calling it a crucial aspect of financial literacy. It's your personal safety net.
So how do we make saving happen? What are some practical, actionable strategies we can use right now?
Harvard offers some great simple strategies. First, and this is maybe the most powerful, pay yourself first. What this means is, every time you get paid, commit to putting a set amount, even if it's small, to start directly into a separate savings account. The best way, set up automatic transfer or direct deposit. It happens before you can even miss the money. You'd be amazed how quickly it adds up.
Automate it. Takes the willpower out of it. Good tip. What else?
Second, keep track of your saving. People who actually watch their savings grow tend to save more. It keeps the goal front and center. Online and mobile banking make this super easy. No excuses. Third, set goals. Knowing why you're saving makes it much easier to prioritize. Are you saving for a down payment? A vacation? Paying off debt? Harvard uses the example of wanting to pay off a student loan. How much do you need to save each month? Defining those clear goals, that Capital One also stresses, gives your savings purpose and keeps you motivated. The better you do now, Harvard says, the easier accomplishing future goals will become.
Pay yourself first. Track it. Set goals. Makes sense. If we're just starting, what's the absolute first savings goal we should tackle before the big dreams?
Hands down, the emergency fund. Quicken calls it money for a rainy day. Investopedia clarifies it's for things like losing your job, unexpected medical bills, sudden car trouble, life's curveballs. This fund is your buffer. It stops a surprise expense from becoming a major debt crisis.
Okay, emergency fund. How much should we aim for and where should we keep it?
The general recommendation, according to Investopedia, is to aim for enough to cover 3 to 6 months' worth of essential living expenses. Keep it in a separate, easily accessible savings account, not your regular checking account. And critically, as Investopedia points out, this money is only for true emergencies. Off limits for paying regular expenses, you need that discipline. Having this fund means you can handle financial stress without reaching for high-interest credit cards or loans. Quicken calls it the first step right now toward protecting your financial security. It's absolutely vital.
3 to 6 months of expenses, separate account, emergencies only.
Yeah.
Got it. So once that safety net is in place, what about longer-term goals? How do we make our money really start working for us?
Right. Once the emergency fund is solid, you can look further ahead. This is where we get into the time value of money and the magic of compound interest. The basic idea, $1 today is worth more than $1 tomorrow because today's dollar can be invested and earn interest, which then earns more interest. It snowballs.
Compounding, like interest on your interest.
Exactly. And the longer your money has to grow, the more powerful that compounding effect becomes. Waiting to invest, as Harvard notes, makes reaching your goals much harder because you miss out on years of potential growth. To really see this in action, Harvard suggests using the SEC's compound interest calculator online. Seriously, go play with it. Put in a small monthly amount over many years. It's eye-opening how significantly it can grow. Starting early, even small, makes a massive difference down the road.
That's a great visual. Okay, so once savings and the emergency fund are handled, the next step is making that money grow even more, which leads us to investing. All right, we've budgeted, built credit, saved, now investing. This feels like the next level, right? Building real wealth, saving for retirement, as Capital One and Quicken mentioned. It's about that long-term future.
It is. But it's also where risk enters the picture more significantly, as Capital One reminds us. Different investments have different levels of risk and potential reward. Before diving in, let's just demystify the stock market. It sounds complex, but Investopedia defines it simply as the collection of markets where stocks are bought and sold. Think NYSE, NASDAQ. It's not just stocks either. ETFs, bonds, other things trade there too.
Okay, so it's just the marketplace. If I want to actually buy something in that market, how do I do it? Do I need a special account?
Yes, you generally need to go through a broker. That's the person, or more commonly now, the platform that handles the transaction for you, as Investopedia explains. For new investors, there are basically 3 types of brokers to consider. One is a full-service broker. They manage everything, give advice, but they charge higher fees for that hands-on service. 2, online discount brokers. Think Fidelity, Schwab, TD Ameritrade. You make the trades yourself, but they offer tools and research, sometimes advice depending on your account size, lower fees than full service. 3, robo-advisors. These are automated platforms like Betterment or Wealthfront. You tell them your goals and risk tolerance, and their algorithms build and manage a portfolio for you. Very low fees, very hands-off, great starting point for many. The actionable step is to figure out which style suits you best, hands-on, hands-off, or somewhere in between, and open an account with that type of broker.
Okay, choose a broker style. Then the big question, what do I invest in? How do I balance running growth with not losing my shirt, especially if I'm new to this?
That's the million-dollar question. And Investopedia is right. There's no single answer. It depends on your goals, how much money you have, and critically, your risk tolerance, how much volatility you can comfortably handle. Let's look at common options, generally from highest risk to lowest. Stocks. Buying stock means buying tiny ownership pieces of a company. You might get voting rights, maybe dividends. Prices swing based on company news, the economy. Very volatile. High potential reward, but also high risk. You can lose money. Needs research.
Okay, individual stocks are highest risk reward. What's next?
ETFs, exchange-traded funds. Think of these as baskets holding lots of different stocks, often tracking an index like the S&P 500. You buy a share of the ETF, you own tiny bits of everything inside. Instant diversification. Less risky than single stocks because your eggs aren't all in one basket. They trade like stocks throughout the day.
Diversification in one purchase. I like that. What else?
Mutual funds. Similar idea to ETFs, they hold a portfolio of stocks, bonds, or other things. Also diversified and professionally managed. Very common in retirement plans like 401k. Key difference. They only trade once a day at the closing price, NAV. Also less risky than single stocks. Important note, check their fees, called expense ratios.
ETFs and mutual funds sound similar but trade differently. Okay, what's generally considered the safest of these?
Generally, bonds. When you buy a bond, you're lending money to a company or government. They promise to pay you back the principal plus interest, the coupon, over time, often called fixed income. Prices move opposite to interest rates. They have maturity dates when you get your principal back. Bonds are rated for risk. Investment-grade bonds are safer but pay less interest. U.S. Treasury bonds, generally seen as among the safest investments on Earth. Good for preserving capital.
Stocks, ETFs, mutual funds, bonds, a spectrum of risk. That leads to a crucial question. How safe is my money when I invest it? We talked about FDIC for banks. What about brokers?
Great question. It's different. Bank accounts have FDIC and CUA insurance up to $250K if the bank fails. Brokerage accounts have SIPC Insurance Securities Investor Protection Corporation up to $500 in securities and cash. But, and this is the critical part, SIPC only covers you if the brokerage firm fails and your assets go missing. It does not cover investment losses due to normal market ups and downs. So yes, stocks and other investments carry risk. You can lose money if the market drops, even if your broker is fine. That market risk is inherent.
Okay, so SIPC protects against broker failure, not market losses. That's a really important distinction.
Exactly. Think of it like driving again. You need to understand the vehicle, investment type, the road conditions, market, and your own comfort level with speed, risk tolerance to get where you want to go safely. Understanding your own risk tolerance before you invest is a key actionable step.
Great analogy. Know yourself, know the risks. Okay, let's shift gears to another essential, sometimes intimidating topic, taxes. Taxes. Nobody loves them, but as Harvard says, if you work in the U.S., they're going to be a large part of your financial well-being. Understanding them, even the basics, seems crucial.
It really is. Our goal here isn't to make you a tax expert, just to give you a starting overview, especially around education, as Harvard's guide focuses on. First basic question, do you even need to file? Depends on your income and how much tax was withheld. Harvard gave an example from 2018. Students needed to file if income, including taxable scholarships, hit $12,000. That threshold changes, though.
Okay, so there's an income threshold.
Right. But here's a key actionable insight. The IRS strongly suggests filing, even if you're below the threshold. Why? Because you might be due a refund if too much tax was withheld from your paychecks during the year. Filing is the only way to get that money back. Don't leave free money on the table.
File anyway, I might get a refund. Good tip. What about specific tax breaks for education? Those seem complicated, but potentially valuable.
They can be really valuable. But yes, eligibility rules apply, and they change. So always check the official IRS website for the latest details. Harvard outlines a few key ones. The American Opportunity Credit. Up to $2,500 per student for qualified expenses, max 4 years. The Lifetime Learning Credit, up to $2,000 per student, no limit on the number of years. Great for ongoing education. The Tuition and Fees Deduction can deduct up to $4,000 from your income for qualified expenses, and the Student Loan Interest Deduction can deduct up to $2,500 of the interest you paid on student loans each year, subject to income limits. Parents might be able to claim it too if they paid the loan and claim you as a dependent. The actionable step: keep good records of tuition paid and loan interest. It could save you real money.
Those sound great. But you mentioned qualified education expenses. What exactly counts
Yeah.
and what doesn't? This seems like a common trip up.
It is. The IRS definition is specific. Generally, it's tuition, required fees, and necessary books, supplies, and equipment for courses. Things paid directly for the academic side. What does not count is often surprising. Room and board, a big one. Insurance, medical expenses, even student health fees, transportation, personal living costs. So just because it's part of your cost of attendance doesn't mean it qualifies for these tax benefits. Big difference. Double-check IRS guidelines.
Okay, that's a really important clarification. Room and board is out. Now, you mentioned credits and deductions. What's the difference and why should we care?
This is a key distinction. A deduction lowers your taxable income, so its value depends on your tax bracket. A $1,000 deduction in the 25% bracket saves you $250 in taxes. A credit, however, directly reduces your actual tax bill dollar for dollar. A $1,000 credit saves you $1,000 in taxes regardless of your bracket. So, the actionable rule of thumb from Harvard: seek out credits before deductions, since the benefit is usually larger. Credits are generally much more valuable.
Credits over deductions. Got it. Makes sense. So obviously the IRS website, maris.gov, is the place to go. Any other key resources for tax info, especially since laws change?
Definitely irs.gov first. Specifically for education, look for IRS Publication 970. And because things change and personal situations vary, if you have specific questions, don't hesitate to consult a qualified tax professional. It's often worth the investment.
Great advice. Wow, okay. We have really covered a lot today. Bank accounts, budgeting, credit, saving, investing, taxes. It's clear financial literacy isn't just one thing you learn, it's an ongoing journey.
That's exactly right. It helps you handle emergencies, manage debt, reach goals, improve habits, as Capital One summarized. It's a lifelong pursuit, they say. A lifelong process, adds Quicken, because finance is always ever evolving. Products change, the economy shifts, your life changes. Continuous learning is key. The great news is, no matter where you are now, it's never too early or too late to build your skills and your peace of mind.
So, for listeners ready to keep learning, keep growing those skills, where can they go? What are some trusted, actionable resources we can point them to right now?
Excellent question. There are some fantastic, reliable resources out there. mymoney.gov from the U.S. Treasury, the Consumer Education section on the CFPB website. For investing, investor.gov from the SEC. The Consumer Advice site from the FTC helps with avoiding scams. Capital One has a Learn and Grow section on their site with lots of articles. Investopedia has a great YouTube channel, a dictionary for terms, and even a stock market simulator to practice without risk that's super actionable. And Quicken has a Learn section with a blog, research tools, and calculators. Plenty of places to keep building that knowledge.
That's a great list. It really shows that developing financial literacy is achievable. There are simple steps, as Capital One said, you can take starting today to gain knowledge and apply it confidently. It's about progress, not perfection overnight.
Precisely. It's never too late. But Investopedia reminds us, it pays to start as early as you can. It starts with awareness, then building good habits, and then the ongoing education to maintain them. Makes a lifelong pursuit. The rewards, financial and otherwise, are huge.
So if money's a tool, financial literacy is the instruction manual. It helps you build the life you want. As we wrap up, think about this. What one financial habit, one actionable step will you implement today, right now, to start building that financially confident life?
Yeah, maybe consider this too. The whole retirement landscape has shifted, right? Pensions are rare. Now 401k IRAs, the decision-making, the responsibility, it's largely on us, as Investopedia points out. That makes these choices more critical than ever. Your future isn't just about earning. It's about wisely managing every single dollar. So what decision will you make today that your future self will look back on and say, thank you? Take that first step.